Hello, everyone, and welcome to the Weekly Watch. I'm your host, John Briggs. This week, we have a bit of a special episode because given all the central banks meetings this week and all the moving parts across macro rates and FX, we're doing a bit of a crossover with my normal Weekly Watch podcast and our rates-driven bondcast. So I'm going to welcome today Paul Robson, co-head of G10 FX strategy, and John Nevruzi, our U.S. rate strategist, to help us sort it all out. Let's start in the U.S., where the Fed hiked by 75 basis points, but significantly revised up their future rate hike projections. John, what's the main takeaways or surprises that came out of the Fed meeting this week?
Yeah, well, going to the meeting, we weren't even sure how the Fed was going to be able to come above expectations, as everyone was ready for a very hawkish delivery following the acceleration in inflation that we saw over the last month. So the Fed managed to do that, and mainly that came through their quarterly projections, where the board presents what they expect for interest rates for the Fed funds to be for the next 4 years in this case. And those expectations were well above most economists' views, including ours. By the end of this year, the median forecast, what's called a dot plot, the median point went to 4.375, which implies another 125 basis point of hikes following this last 75 basis point hike. So that puts the base case for November back to 75 and December for 50. That is also what we have for our expectations. And looking ahead for 2023, the dot plot showed 4.625%, again, much higher than what most had penciled in. And perhaps even more remarkably, into the later years like 2024, 2025, the projections do show cut in interest rates, but not nearly as much as what was expected by analysts. Just for context, for 2024, they see only about 80 basis points of cuts, going back to 3.8%, not much further than that. And that's going to be an interesting thing to look out for, because data could slow down, growth data could slow down when this excess levels of tightening, while it will become like a game of what gives in first. Does the Fed back out and decide to cut, or they manage to kind of hold through as data weakens and try to fight inflation? Our in-house forecast is that they will be able to hold rates steady for next year. We actually expect the Fed to reach a 5% terminal rate, so a couple more hikes early into next year after getting to where they are. So we'll see how it develops, but certainly a much more hawkish delivery than what was expected by most, and markets reacted accordingly.
Yeah, and my first reaction to what you just laid out, which is growth slowing, 5% Fed, but not changing from 5% all next year despite growth slowing. It's a very different reaction function to the last few cycles where the Fed has reacted to slower growth, and kind of reinforces some of my concern about risk assets. So, John, more specifically, when it comes to our expectations for U.S. rates, do you think we're close to the end, the adjustment higher in yields? Two-year yields now over 4%. They're at their highest level since 2007. 10-year yields are closer to 375 than not. So do you think we're close to the end? Do we have a lot further to go, or what are your thoughts on the rate structure?
I don't think we have a lot further to go, but these could be the famous last words before rates kind of find another leg higher. But yeah, like you said, we're pretty close to our forecasts. At some point, it's going to become harder and harder to add the incremental tightening onto the curve, especially as data starts slowing. So it will become challenging for the Fed to persuade the markets that they're going to indeed do more. They go to 5, 6, 7, whatever. It just becomes significantly harder with each step. So we do think that we are reaching those levels. We still think the curve will perhaps marginally flatten a little bit more, but the risks are for the Fed to do more, agreed. But seeing rates going much higher from here is not something I would chase. We're actually looking more to get into these steepeners that might come early next year, but the timing for that still doesn't seem right. Like we talked, it's still too early for the Fed to back out while risks remain for higher rates in the front end. But as far as overall levels go, I think it's going to be a struggle to push much further higher from here.
Okay, thanks. Let's switch gears to the UK. Paul, we just had the Bank of England meeting really just we're recording this on the heels of it. So as usual, I'm doing the unfair questions, so I'm not giving you much time to react even to the meetings. But in my weekend piece, I wrote that it's hard to see a particularly positive outlook for the UK in the near term. So I will say is when it comes to the meetings, some of the markets were looking for 75. We only got 50. Does that mean the bank may not go as high as feared, or does it just mean the tightening cycle is going to be a little more drawn out?
Well, we think the decision to just go 50 when markets were almost pricing 75 is important to the outlook. If the bank had gone 75 today, then I think it would have gone a long way to validating market expectations where we could get a peak in interest rates at 4.5%. The fact that they only went 50, I think just keeps the jury out about the ultimate endpoint to tightening. But it's, given inflation pressures in UK economy, then it still remains relatively uncertain. I mean, I think the key takeaway for me personally from the Bank of England was that it had a feel about, let's all just come back in November and see where we are. And then we can make a decision about whether we need to guide markets to a higher terminal rate or something a little bit lower. By then, the Bank of England staff would have had time to fully assess the mini budget that we'll get tomorrow, and also fully incorporate the government's cap on energy prices. Now, personally, I don't think you have to overthink it. You've got 200 billion potentially of additional stimulus into the UK economy that feels inflationary over the medium term. But optically, it was always going to be a little bit poor if the Bank of England had gone 75 today, the day ahead of a mini budget from the government. So I think today we're just left with, as you are really, maybe on balance, maybe a little bit more tightening than we previously had expected. But I don't think there's any reason for the market to really change their pricing at this point.
Yeah, and it's interesting. You are seeing yields moving higher. I mean, as we're recording this, 10-year gilt yields are 16 basis points higher. That's even before we've gotten the mini budget. We're recording this before the mini budget comes out. But and putting my rates hat on for a second, we do see 10-year gilts going to 4%, but that's as much driven by massive gilt issuance that we're expecting, nearly triple next year than it was this year. We'll see how the budget impacts that. But I wonder if in a little bit the market's saying, oh, we only went 50 this time. That means you have to do more later. But as you said, I guess we'll put a pin in that until the November meeting. So let's turn to sterling now. Now, the meeting didn't really have a major impact on the currency, but bigger picture, it's had some significant declines. And importantly, both against the dollar and the euro. Do you think, parity in either one of those crosses or further declines are in our future?
Well, I think it's still your risk case rather than your central case. The outlook for sterling is still very challenging given the policy outlook, the slowing of the economy, but still persistent inflation pressures against a backdrop of having to fund a large and persistent current account deficit. The reason that I don't think it's your base case at the moment is that you have to remember that the dollar is at decade highs, multi-decade highs. The challenges for the euro area are probably just as great as they are for the UK. So that doesn't in itself really suggest that, say, euro sterling is going to go significantly higher. But you're exactly right to reference the fact that euro sterling has been moving higher, which has made it sound and feel a bit more of a sterling story. In terms of the outlook, it really just comes down to funding a large and persistent current account deficit when growth is weak. Now, if you think about the government's policy to cap energy prices and that massive fiscal stimulus, I mean, we're talking 6-7% of GDP over the next couple of years. That's awfully a large amount of money to be pumping into the system. At one end, it means that forecasting a recession in the UK is going to be really quite hard, and therefore it might attract a little bit more capital inflow into the UK. But where is that money going to go? A large proportion of it will go on imports, which makes the trade deficit even worse. So until you get some signs of stability in energy prices, maybe the economy starting to recover, or expectations of that, I think that sterling continues to go weaker. So lower cable, for example, and probably upside pressure for euro sterling as well.
All right. Before I sign off, one more for you, Paul. I mean, you did mention the dollar has been on quite the run, multi-decade highs, year highs. And we had a bit of a pause there after a surge this year in August, but we're seeing renewed rallies. I mean, just from a big picture, what do you think would turn that around? I mean, we had some BOJ intervention, but that's only really impacting the yen. What do you think could actually make that trend turn around?
Yeah, I don't think it's going to end in intervention. You mentioned the Bank of Japan. I think that's more about slowing the pace, not making dollar yen a one-way bet, maybe squeezing speculative positions. But it is an important event, especially when you think that the People's Bank of China are also trying to lean against dollar strength. As we've mentioned lots of times before, dollar CNH is a key anchor for the dollar, as is euro dollar. So the fact that they're pushing back on that's important. And also other central banks in Asia have just started to lean against dollar strength. So it's important, but I think we're not going to, this doesn't end in some kind of plaza accord, not least because it's not in the US's interest. They need to get inflation down. Currency strength is helping in that respect. So what does ultimately turn the dollar? Well, it will be relative growth. It will be some signs that the world economy is strengthening at a time when the US is slowing. So within that, we're watching COVID policy in China, Asia, demand more broadly. We're watching energy prices in Europe. At some point, you get past the point of peak pessimism. And so global growth starts to recover at a time when US growth continues to fall. Or you get a sharper correction in the US economy. But at the moment, that really doesn't seem likely. So further dollar resilience, I think, is the way forward here.
Makes sense. All right. Thank you, Paul. Not an easy time nor easy questions to answer. So I thank you and John for your perspectives on all this. Next week is a bit lighter on big events. We have some US inflation data, UK GDP, European sentiment, and inflation data out of Germany. And with that, I think I'll leave it here. Good luck, everyone. Have a good week. So thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so that you can watch our latest episodes as soon as they're available. And hit the like button so it's easier for others to find. Thank you.